Welcome to our tutorial on understanding the profit and loss statement for a car manufacturing business. Today we will break down each line item to help you understand how revenue, expenses and profits are calculated in the car manufacturing industry. Let's get started. Let's begin with the revenue section. For this example, we are looking at the profit and loss statement for a car manufacturing business. The two primary sources of the revenue in this industry are new car sales and accessory sales. New car sales represents the revenue generated from selling the brand new cars, and accessory sales represents the revenue selling from additional accessories like custom rims, performance exhaust, advanced GPS system, and other things. When you add these two revenue sources together, you get our total revenue. As you can see in the Excel. Now let's look at the cost of goods sold. This is also known as the direct cost associated with the manufacturing cars. These costs are necessary to produce the vehicles and are considered the cost of revenue. The major components of cost of goods include raw material cost and manufacturing and assembly cost. The cost of material used to manufacture the car such as metal, plastic, rubber comes under the raw material cost, and the labor, machinery, engine assembly, interior fitting installations comes under the manufacturing and assembly cost. When you sum up all these costs, you get a total cost of goods. Then we calculate our gross profit. What is gross profit? Gross profit is the difference between the total revenue and the cost of goods sold. It tells us how much money the company makes from its core operation after accounting for the direct cost of producing the cars. To put it simply, gross profit represents the money left after covering the costs that go directly into making the cars. Here's how we can calculate the cost of gross profit. When you subtract total cost of goods from total revenue, you to get gross profit. Here you can see the formula of gross profit. Then we have operating expenses. Now let's move on to the operating expenses. These are the costs associated with running the business on a day-to-day basis. Here's a breakdown of the key operating expenses. These are the costs associated with. Now let's move on to the operating expenses. These are the costs associated with running the business on a day-to-day basis. Here's a breakdown of the key operating expenses. Selling expenses. These expenses include marketing cost, advertising cost, promotional activities, and sales team expenses. General expenses. These are the overhead costs like office rent, executive salaries, and utilities. Staff costs include hourly wages and salaries and other overtime pay. If the cars are under warranty, the company must cover repair and maintenance costs, which are included in the extended warranty expenses. To incentivize the dealers, companies often pay commission based on the car sales that comes under the commission for dealer expenses. When we sum up all these accounts, we get our total operating expenses. Operating expenses is also indirect expenses, which is related to manufacturing or running the whole business.
Then we have the operating profit. Operating profit is the profit the company makes from its core operations after subtracting operating expenses such as marketing, office rent, and staff salaries from the gross profit. This figure tells us how well the company is performing in its day-to-day business activities, excluding external factors like finances and taxes. Here's how you can calculate the operating profit. When we subtract operating expenses from the gross profit, we get our total operating profit. As you can see,
Apart from primary revenue and expenses, the company may also have additional source of income. These are typically listed under the other income. First is the rental income. This can include rents from the our properties that comes under the rental income. If the company owns stakes in other business, it can receive income from those investments or extra income from any other investment that comes under the interest income. Then we have the miscellaneous income. This covers the income from selling scrap materials or any other extra things. When we sum up this all incomes, we get our total of other income. What is EBITDA? EBITDA stands for earning before interest and taxes. It's a measure of how much cash a company makes from its regular business operations before accounting for things like interest on loans, taxes, etc. Think of EBITDA as a way to see how well the company is doing at generating cash from just its normal business activities without getting into complicated stuff like how its finances, its operations, or how its assets wear over out of time. Here's how you can calculate the EBITDA. When you add other income in the operating profit, you get total EBITDA. Finance cost. At some point, businesses often need external funds to operate or expand. This leads to the finance cost, which are interest and fees paid on loans or credit taken to fund business operations. Finance costs are an essential part of understanding how much it costs to borrow money or business growth. Then we have the profit before tax. This is the total profit earned by the company before taxes are deducted. Here's how you can calculate the profit before tax. When you minus subtract finance cost from our EBITDA, we get our profit before tax. Then after applying a tax, then after deducting the tax from our profit before tax, we get our total net profit. This is the total actual profit of our business that we have made for the year. Here's how you can calculate the net profit. When you subtract tax and finance cost from EBITDA, then we get the net profit. In summary, the profit and loss statement provides a clear breakdown of how the car manufacturing business generates revenue and manages its expense and ultimately earns a profit in the year.